Word on Wall Street, top investors watching your money. Excuse me, joining me now, Michael Lee strategy founder, Michael Lee. That's my clearing my throat, Mike, was no knock on you, my friend. Macro Trends Advisors, founding partner Rich Rochelle, and Strategic Wealth Partners investment strategist Luke Lloyd. I got a little tickle in my throat there, Michael. Maybe you do that to me. Let's kick things off with you. Futures in positive territory this morning. It's going to be a big week for investors as we wait for the Federal Reserve decision on Wednesday, along with some key economic numbers out later in the week as well. Retail sales, the May Producer Price Index. Michael, what are you watching? What's most important here?
Yeah, Dagan, I'm looking at the bond market, and we have a 10-year Treasury that's firmly found a home right in the 150 area after it looked like we were on the way to 2% earlier this year. Now, what does that tell you in the broader context of markets? That this inflation fear and these inflation scares that have been holding back the market for most of this year are going by the wayside. I don't expect any major news out of Jerome Powell this week. Maybe he makes a slight faux pas that freaks markets out a little bit, but him using the word transitory, which is a stupid way of saying temporary, to describe inflation, I think is very accurate. I think the bond market agrees with us, and the path of least resistance for the markets is higher. I expect to start to see multiple new highs as we enter the second quarter. We're looking at 62% earnings growth year over year, and that's up from 52% just a couple months ago. I'd say that number's probably low, and I'd look to see estimates go up for later this year. So I would look, and lastly, I would also look for tech to resume their leadership. So expect a good few weeks and a good few months for the Nasdaq.
But how hard? Let me rephrase that. Is the yield on the 10-year, is the bond market an indicator of anything, given the unprecedented intervention that the Federal Reserve has undertaken in the last year or so by, I think that, and somebody correct me if I'm wrong, but 59% of the debt issuance by the U.S. government was sopped up in essence by the Federal Reserve. So how much of how poor of an indicator maybe is the yield on the 10-year, Mike?
You know, Dagan, what I look at really closely is the difference between the 2-year and the 30-year, the shape of the yield curve, that slope. That is the bond market's prediction of inflation plus GDP growth over the next 7 years. And what they're telling us is that average is a little over 200 basis points or 2%. That's the highest since early 2017 and since the early since the early 2010s when we were coming out of the great financial crisis. So to me, I'd say the bond market is doing a fairly good job of handicapping what's looking going forward, which is a low growth, low inflation world. So maybe without quantitative easing, that 220 basis point gap would be at relatively higher rates. But what I see from there is not a lot of growth, not a lot of inflation, which seems to jive with what we're seeing in a government expanding, liquidity-driven global markets, if that makes sense.
Makes sense. Perfect sense. Mitch, let's talk oil.